Not a bad second day of the week, guys. A little bit of a follow-through day. My name is Hamilton. I'm here with the Trading Initiative. Let's talk about today ending May 7th, 2024. Obviously, we wrapped up Tuesday with stocks up, bonds up, and dollar up, something that we don't normally see. All five of the major indexes that we track on a consistent basis, small caps, transportations, the S&P 500, industrials, and the Qs all finished green on today, which is obviously great. The short-term and potentially intermediate term trend reversals to the upside are solidifying themselves, and we might be seeing all-time highs relatively soon. The biggest mover today, sector-wise, materials. Did we bottom out here in the middle of April? That's kind of the pivot point that we've been seeing across many different sectors. That April 19th day, was that the actual bottom? We're seeing a lot of strong bounces back up and over all-time highs, and we want to be long when we're back up and over those all-time highs. We have a line in the sand for materials at 90.75, and we close today north of 91. So although we do have some exposure materials, we will be continuing to green light exposure. We want to continue to be buying this stuff as long as it's breaking back out into all-time highs. Financials, another one that has almost completely reclaimed its April drawdown and has since closed above its pivot at $41, currently trading at $41.15. I tend to think this is incredibly constructive bullish action continuing to form on most of the major sectors here. Now, tech ended up down on the day, 0.33. A lot of that was concentrated weakness. Comms ended up today. Consumer discretionary ended up down today. But here's something for you. Tech and consumer discretionary closed red on the day. Comms barely up, and yet the Qs went ahead and closed green. That's something we don't normally see every day. And if we look at an equal weighted standpoint, RSP, or equal-weighted S&P 500, is continuing to climb back up and over that all-time high pivot. So once again, we are reclaiming that April drawdown. We are back onto risk-on mode inside of TTI. QQEW is still trying to work up there, which shows you that there is a lot of strength outside of some of the growth areas of the market right now, particularly financials. We really like the financial space right now. We have a lot of exposure in the financial space in particular, but we are buying again. Right? We went through this in yesterday's video. I showed you kind of the weekly checklist that we look at every Monday, where we look at short-term, intermediate-term, and long-term trends. And the intermediate-term trend was never harmed at all, was never in danger of being harmed at all. The 200-day moving average remaining intact across the board. But the short-term got obliterated, and the intermediate-term actually got hit as well. And we're starting to see a lot of constructive price action come in. Now, something that's a little different today that you don't normally see is stocks up, bonds up, and the dollar up. That's generally not something you see. From a bond perspective, I really like the fact that for the fifth straight session, bonds have been bought. We've come down slightly intraday, but this is a really awesome little short-term trend we have forming here in bonds. I'm not ready to commit capital to the bond space. I'm not ready to go out and buy the TLT like we did back in October, which ended up being a triple-digit win. I did not personally grab it, but a bunch of guys inside of TTI did, and that was a fun little trade up through the end of 2023 with the bond play. Here we are again, pressing up in towards this magical line that for whatever reason the market tends to really react to, this 92 level. What happens at the 92 level if we get there? I'm assuming we probably will relatively shortly. Is it going to act as resistance, or are we going to blow right past it? And now we have a little bit of confluence here with the 200-day moving average and that 92 level both around the same spot. So it's a pretty important chart to be looking at right now. Obviously, we know that there's a positive correlation between the bonds and the equity market right now. Whenever the bonds are not going down, generally equities are being bought. And when bonds are being bought, equities are for sure being bought. So right now, we're continuing to see that over the last 5 days. Some strength in bonds, but what happens when we get back up to that 92 level? There's a lot to be answered at that 92 level. The dollar ended up rebounding for the second day in a row here, closing right underneath that 105.5 area, 105.374. We have to ask ourselves, is it going to eventually blast back up into that 106.5, or is it going to be pinned underneath the previous support now turned resistance? I'm in the camp that this is probably going to come up and retest it and then break back down before heading towards the 200-day moving average. I could be completely wrong here, but by the way things are moving in the market, some of the riskier assets of the market are being bought against, some smalls and mid caps that are overperforming. I think that the dollar is in the losing seat here, if you will, at least in the short term. Primary trends in the dollar are still up. I just want to point this out. The primary trend is still up in the dollar. It's been screaming to the upside here for the last few years. But short term, which if the dollar does continue to break back down towards the 200-day moving average, I think will give the market legs towards an all-time high. And by the way, guys, I know it's scary to think about for some people out there, but if we shift clicked up from the market closing price right now and up towards that all-time high, we're less than 1.5% away from all-time high. I know people don't like it. I get it, but that's the fact. Market is very close to an all-time high right here. It does not going to take a whole lot to continue to push this thing back up into all-time highs. And then what happens? Winter if it does. All right, we went through this yesterday. CTAs are caught off guard. Professional money managers don't have enough long exposure. Just something to consider there. One thing I want to point out is that when you're trading, particularly technically, you have or should have some sort of system in place, checks and balances that are going to get you in and out of positions based off of price and not opinion, not fundamentals. If you're a technical trader, you follow price as your guide. You have to take the setups as they come. And there's no better example in my mind than some of the Mag 7 stocks. We're long some of these Mag 7 stocks. We're long Google off of the all-time high pivot at the 152.5 area. We're long Amazon right now into the potential all-time high breakout. Not all of them are going to work, but these are the biggest stocks in the market for a reason, and they are at all-time highs. We probably want to own these things. To give you guys a little bit of encouragement, I know there's always a million reasons to be afraid of the market, but I'm not kidding when I tell you that we own this stuff. We're not afraid of owning things that statistically have edge. They're not all going to work, but I'm going to tell you guys something. You're never going to feel completely comfortable owning a position, because by the time it does become completely comfortable taking the trade, generally speaking, most of the alpha of that trade is going to be gone. By the time the normal person is ready to take the trade, they have enough confirmation, they think this trade's great, majority of the time, the easy trade, the alpha in that trade is going to be gone. And I want to kind of close this particular video with something that I wrote today in our market research portal. I want you just to look at it. I captioned it, "When in doubt, zoom out." And yesterday I had a conversation with one of the traders in our trader development program, and he's a winning trader, as you can see here in a second when this populates. He's up around $8,000 this year. He's a winning trader by every metric, right? Obviously, he's made money, 51% win rate. Average win hold versus loss is very good. 23 days versus 14 days to the prop factor of 1.91. So he's a winning trader. He's a smaller account. He's looking to build his account through our system and learn how to swing trade efficiently through different market conditions, right? But one thing that he said yesterday that really stood out, that I think a lot of you guys can learn from is, and I'm just going to read it verbatim, "Dude, I think hearing tiny movements up and down is just too much for me. I need weekly updates versus daily. I can see the trend clearer." And I couldn't agree more. There's a million reasons to always be afraid of the market. If we go back to TradingView really quick, I want to point something out. If we look at SPY, for example, we could sit here and we could have a million different reasons why we're afraid. We're extended off of the 200-day moving average by way too much. The correction wasn't deep enough to even call it a correction. The RSI is still not within a bullish momentum regime. CPI is coming up. NVIDIA earnings are coming up. There's a war going on in Europe. There's a military conflict / war going on in the Middle East. U.S. debt's out of control, blah, blah. There's a million things always that you should or could be worried about. But I'm going to tell you something. As Curtis Faith said in Trading from Your Gut, 99.9% of the things that you read and consume on an intraday basis are going to actively sabotage you from making the right decisions in the market. Most of the things that you are worried about mean absolutely nothing in the grand scheme of things. So once again, as I laid out in the premium newsletter for the monthly or the market research side, when in doubt, zoom out. All I'm going to say is, if you're ever worried about whether or not market's going to pull back, when you go out on the weekly and you turn this into a line chart, does this look like a market that is about to break down into new bear market lows, which would at this point be below 400? Guys, probably not. My name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe. Leave a comment below. Sign up for the free newsletter. Link is in the description. I will send you the first one tomorrow morning. And I'll catch you tomorrow in the next market update.